Just want to welcome everybody to today's webinar. I am here with Jack Krupey, principal and founder of the JKAM Alternative Investments Fund. Again, I am William Bonati, partner in the JKAM Fund, and I'll be the host today. Today, we'll be diving into why diversify your portfolio in real estate and alternatives. We welcome any questions you may have, and we'll address those at the end of the webinar. So let's go ahead and jump in to the agenda for today. So many of you already know us, but for those of you that are new, we'll be doing a brief introduction. We'll touch on our experience, our observations, and some of the data on the markets, give an overview on the Diversified Real Estate Fund and why, the current holdings of the fund, and how you can learn more. And lastly, open it up to any questions and feedback you may have. So let's go ahead and jump in. So for those of you that don't know me, I am William Bonati. I grew up in Colorado and went to Colorado State University, got a degree in finance and real estate. And right out of college, I got a license in the Series 7, 66 in life and health. Started my career with a big insurance company and then transitioned into banking, working as a licensed financial consultant, then as a financial advisor, and then ultimately transitioned into more of an entrepreneurial career by investing in real estate. And I started in real estate by wholesaling, then doing renovations and flipping houses. Then I learned about MPLs and started getting into that because it was scalable and something that I could do remotely because my wife and I were moving every 3 to 4 years for her medical training. And while we were in New York City in 2014, I connected with Jack and then joined his team at the previous fund to run his NPL dispositions trade desk. And I was there for 2 years. And then Jack and I left that fund and it partnered up again to run the JKAM Diversified Real Estate Fund. My family and I currently live in Vail Valley, which many of you may know of or visit from time to time. So if you're ever out this way, let me know and I'll show you some great powder stashes or a local fishing spot. And now most of you know Jack or know of Jack.
I started in real estate shortly after college. I went to school in Rochester, New York. Actually, I have a degree in information technology, but got out right during the dot-com crash. And, that was sort of the beginning of the real estate boom. So I started buying properties in Rochester, got my real estate broker's license, was a flipper, was a wholesaler, did pretty much all the traditional real estate strategies until 2008. Then during 2008, I was able to land a role at a private equity fund in New York that was buying distressed mortgages. And they needed people like me that had the traditional, real estate house flipper, short sale background to handle a lot of the incoming requests. So learned that business and was there for about 2 years and then left and went on my own and formed a firm called Gemini Capital Advisors. We had partnered with a small family office that was helping us buy and sell non-performing and performing loans. And then we partnered with a larger private equity fund in 2014. And that scaled from, the first portfolio was about 5 million and eventually scaled to it's over 3 billion in total purchases. It was a great run. But as more of an entrepreneurial person, I was always looking for other things to do. So during that time, I was also investing myself into various multifamily syndication projects, which some of which we'll outline later, which is what the fund has become. So when I left in 2019, I relocated to Puerto Rico. Most of our investments are, at this point, all of the fund's investments are still in the States, but I run the business from Puerto Rico, where it's about 80 degrees all year round. And there's also just interesting other incentives down here.
Yeah.
So that's my story.
Yeah. Awesome, Jack. Thanks for sharing. Yeah, that's a pretty cool story about your, exponential growth there with the private equity fund. So moving on. So let's jump into, some of the observations that we've seen. and look at some examples that we can draw on from history. So, as you guys well know, the market has gone through many extreme ups and downs. And when we look back, we're reminded that, yes, a market crash is a very difficult thing to go through, but it's something that we can overcome. So, the Great Depression was in 1929, and over the course of a few days, the Dow dropped 24.8%. And it took over a little over a decade for the economy to get back to pre-depression levels, and a lot of that was driven by industry from the World War II. The next one was in 1987, and the market lost 22.6% of its value in one day. That was known as Black Monday. But within 2 years, it had recovered everything it had lost. The next big drop that we saw was the dot-com bubble. That was driven by speculation from basically mid-90s to early 2000, and it all came crashing down and was further impacted by the events on September 11th in 2001. And that recovery took about 2 years. And then again, we saw another recession in 2008, and the Dow Jones Industrial Average lost about 50% of its value in a very short time. However, after a couple of years, the market was stronger than ever before, and we essentially have been in a bull market period since 2009 to just before the coronavirus crash, and that happened as you all are familiar with and know of in March of 2020. The COVID-19 pandemic triggered the most rapid global crash in financial history. However, the stock market again regained ground relatively quickly, and the year closed with record highs in all major indices. So, as a financial advisor during the 2008 recession, I can speak to how challenging it is for investors to not panic and sell during the dips, thereby realizing losses. When if they would have just stayed invested or stayed the course, or maybe invested more, they would have come out on top. And so that said, never in my time as a financial advisor did I have a client say during a major upswing, "Hey, this market has been doing really great, and I think now is the time to take some money off the table." Ultimately, my point is, in general, people lose in the stock market because they are emotional and make irrational decisions. One of my favorite quotes further illustrating this point is by Warren Buffett, and he says, "Be fearful when others are greedy, and be greedy when others are fearful." So now may be the time to be fearful of stocks. So looking at this chart, we've got the NASDAQ historical, and the gray bars indicate recessions. And you can see most of the major dips or corrections in the market are during recessions. Taking a look at unemployment, while the stock market has recovered since March of last year and is hovering around all-time highs, this success hasn't been reflected in broader economic data. The U.S. economy added a tepid 49,000 jobs in January, which was much less than expected. The unemployment rate ticked down to 6.3%, but for the wrong reasons. And those reasons primarily were the labor force participation fell as fewer Americans tried to find jobs. The long-term unemployment has shown no improvement, as seen in the chart. Nearly 40% of unemployed individuals have been without a job for at least 27 weeks. And aside from 3 years after the 2007 to 2009 Great Recession, this is the highest percentage on record. Permanent job losses also ticked up in January, underscoring that scarring effects on the unemployment are becoming widespread. Taking a look at another economic indicator, GDP saw a sharp decline in the wake of the onset of the pandemic. It did bounce back in the third quarter, but dropped again to average levels in the fourth quarter, showing some vague signs of stability. But considering all the current economic variables, it's really hard to be confident in any short-term stability. And here's a quote from Randy Frederick, who is the VP of Trading and of Derivatives at Charles Schwab. And he says, the kind of craziness we're seeing right now is not atypical of the kind of craziness you tend to see when we're ready for a little bit of a downturn. So again, just highlighting Warren Buffett's quote of, when people are greedy, be fearful. It would seem as though there are a multitude of signals of upside exhaustion in the equity markets. Furthermore, to that point of irrationality, you can take a look at what's happened with, the Wall Street Bets Reddit and GameStop, Nokia, Bed Bath & Beyond, and a few other companies. And now I realize there's a lot more to this story. But Main Street investors have really enjoyed jumping on the bandwagon to punish or get revenge on Wall Street firms. But again, it just speaks to the irrationality of the equity markets right now. So with all that said, if you're not already investing in other assets like real estate, now may be a good time to have a closer look. And this is really why. So as you can see on this chart, real estate has outperformed equities by a significant margin over the last 20 years. And while we're not saying you should stop investing in stocks altogether, we're just saying that you should take a look at other ways to passively invest in alternative asset classes like real estate. And Jack, maybe why don't you take us through some of the data on real estate, specifically multifamily, which is the type of real estate JKAM fund primarily invests in.
Sure, Will. And thanks for that in the prior slides. So this slide shows a chart for CBRE. And for those of you who aren't familiar with CBRE, they're one of the largest commercial brokerage and advisory firms in the world. And they provide a ton of research to the market. And you can see here the effect on rents during the period after the 2001 recession. And multifamily has only dropped 6.7%, whereas industrial and office space were down significantly higher, with office as low as 17%. And the second chart shows the growth rate, and as you see there, multifamily recovered to a greater amount and faster than the other asset classes. So it's proven time and time again to be a stable and recession-resistant asset. Okay, this next chart here just goes into a little bit of the what happened after the 2008 global financial crisis. Now, if you remember, this was a time period where there was many foreclosures. The period going up to the financial crisis, it was very easy to get a mortgage. So there's record high home ownership. So if there was ever pressure on multifamily, it was during that point. And even then, it was still the most resistant of the asset classes, and also recovered the fastest. And another chart here just again illustrates the stability during times of recession. Again, the gray bars are the recessions. And my takeaway from this chart is that vacancy is relatively stable from 5 to 11%, with again the outlier being kind of the early to late 2000s, when said anyone with a pulse could get a home loan, could get a mortgage and be a homeowner. And then with 2010, with the foreclosure crisis, there was just a lot of cheaper single-family homes available. So even with those, the demand has been strong over a period of decades. So speaking of what we've seen over the last year, the national statistics are that rent collections are at 76%. I think this is skewed tremendously by areas in major cities like New York, San Francisco, Los Angeles, that have had just citywide shutdowns and much more major disruptions. Across both our portfolio and then personal investments I'd had prior to the fund, our collection rates are in the 95% range and within 1 or 2% of original projections. Actually, a number of the properties, the actual net operating income has actually increased. What we've seen is our portfolio is concentrated in the Southeast, as well as an asset in Phoenix. And these are generally areas that people are moving to as people have left the New York City metro and to move south, or have left California to move to Arizona. Rents are actually rising in these places because single-family home prices are also rising because there's just not enough inventory, and that demand then kind of flows into apartments where it's just not feasible to find a house to buy, or if you're moving from a new area, you're going to start in an apartment until you can figure out ultimately where you're going to buy a house. Right,
exactly. Yeah, demand is super high for rentals.
Great. And then this will be the last data slide here, just in the interest of everyone's time. But again, this is another chart from CBRE, and it shows the demand for multifamilies is forecast to have a significant increase this year.
Awesome, Jack. Thanks for bringing us up to speed on multifamily and why it's a great asset class to take a look at. Why don't we go ahead and jump into the JKAM fund? And Jack, why don't you share with everyone sort of the genesis, the strategy and benefits of the fund?
Sure. So as Ed said, I actually started investing in multifamily a number of years ago while I was still working in distressed debt in New York. I had a friend of mine that it was actually a group that we're likely to partner with over the next couple of years, and he was buying larger multifamily apartment complexes in North Carolina, South Carolina, and Georgia. So I've been familiar with the market for a long time, and one of the challenges I had was deciding on which deal to go into, because these were generally done on a property by property, deal by deal basis. You never knew when the next one was going to be available, so it was also very tough to budget investment cash, because sometimes 2 or 3 projects would happen at once, and then there wouldn't be another one for 6 months. So, yeah. When I sought to set up this fund, I wanted to provide access to my investment community to this asset class that's been very good to me and has historically strong returns. And I wanted to provide diversification across multiple properties, multiple experienced operators. Some of the people we partner with, I've known for 10 plus years, and have, some of them have 20-year plus 30 years track record of success in these opportunities.
Right.
We have, and these are groups that get the last call when there's a property that's listed. For example, the newest deal in Atlanta, which we'll have a separate webinar in the coming weeks, was off market because the group that we're already invested with in another Atlanta project owns the one next door. So they got the first call, and it was a private deal. That's the type of access that we have access to, that we provide our investors access to. And the last factor is really the tax advantages of this strategy. I spent a lot of the last decade in the non-performing, reperforming loan space, which was a great space at the time, and of that part of the economic cycle. But unfortunately, there's minimal tax benefits in that space. With these real estate projects, with the depreciation that passes through, it really is a tax-deferred investment opportunity. In most cases, we're actually passing through a paper loss, even though you're earning a mid-teens return overall. You're actually showing a loss on paper for the first few years, which defers income tax, and in some cases could actually help defer other passive income that an investor has, whether it's other rental properties or other passive income. So it's extremely powerful.
Right, exactly. Yeah, we'll touch on that a little bit more later on here in the presentation. So let's just briefly cover why invest with JKAM. And there are really 3 major reasons. As Jack just talked about there, with our experience and expertise, you can participate in quality, stable, risk-averse projects that are typically hard to source if you're not in the industry. The second is the diversification you get in our funds. For example, you can get exposure to many operators, projects, different geographies, and asset classes, which does provide a balance of current cash flow and also upside potential. And the last and third major reason to participate in the fund is you'll receive a higher preferred return, lower management fees, and a percentage of the carried interest, which you could not achieve by investing directly in a project. And as I just mentioned, one of the benefits to our fund is asset diversification, and the overall fund asset allocation looks like this. So 50% of the fund will be in stable multifamily projects that are fully occupied and have positive cash flow. 25% will be in higher upside, ground up type development projects, specifically senior housing. And the remaining 25% will be, again, in higher upside transactions like non-performing loans, REOs, and potentially some bridge or hard money lending. And that's a space that Jack and I have a significant amount of experience with. So again, here you can see the asset classes. One asset class not shown here is mobile home parks, which we are evaluating due to their significant tax advantages. But again, we have multifamily projects, development and construction, which is the senior housing, and bridge lending and loan acquisition. But it's primarily going to be loan acquisition, so reperforming loans and REOs. So Jack, why don't you share you touched on this a little bit before, but why don't you just give the group a brief overview on the tax benefits?
Sure. So, I think one of the best benefits of these real estate type deals is that investors get an immediate tax benefit. If you're invested in the stock market, there's no tax benefit unless you're realizing losses, which is something you never want to do.
Yeah, it's not a good strategy.
Yeah, it's not a good strategy. But with real estate, even while you're earning a profit, you're actually generating paper losses during, and that can be significant in the first few years. For example, one of the projects that we invested in actually all of the projects do cost segregation studies, but an example on the one project in Atlanta, Georgia, for every 100,000 we invested, we're going to receive a $56,000 paper loss the first year. And that's on a project that we're generating. We've already got our first distribution, and we're going to make roughly a 8 to a 10% return the first few years, and the overall IRR, which is somewhat correlated to annualized return, is going to be 17 to 18% most likely. But that depreciation pass through is significant because that will cover the preferred return we pay, and for many investors actually covers other passive income they may have from rental properties, or other passive income sources. So the cost segregation that's done on multifamily, which is really not feasible on single family houses. Some of our investors own a couple single family houses, and they're like, can I do that on my own properties? And it's just it's cost prohibitive on say a $200,000 house. You really need to have a 50 to 100 unit building before it makes sense to do the cost segregation, which allows you to take a lot higher percentage of the depreciation in the first few years of owning a building.
Yeah, makes sense. So some really great tax benefits for our passive investors there. So thus far, the fund has made investments into 6 multifamily projects, which you can see here are in pretty diverse geos. Ultimately, the fund will likely make investments into as many as 15 different multifamily projects. And, as you can see, we got stuff in Arizona, or a project in Arizona, Augusta, Georgia, Jacksonville, Lexington, Greenville, South Carolina, and Atlanta. And so, Jack, why don't you talk us through what the fund's expected return is?
Sure. So, most of the projects, as we showed before, at least half the projects are already significantly stabilized, cash flowing multifamily, which also have upside potential through the value add in renovating the units and raising the rents. So, we're targeting paying, depending on the share class, we pay either a 6 or an 8% preferred return on the equity share classes, and that's paid quarterly. And as the buildings increase in value, we will be returning capital through a combination of cash out refinances of the buildings and or building sales. And when you factor in the current, the cash on cash return from preferred returns we pay, and the upside on the liquidation and the profitable selling of the buildings, we're targeting the overall IRR to be, in the 15% plus range after fees. And again, we don't get paid until investors have their preferred return and all of their money returned. And at that point, it's a 70-30 profit split. So we have all the incentive in the world to return capital as quickly and as efficiently as possible and generate profits.
And Jack, speaking to that, having aligned interests with our investors, we're both personally going to be invested in this fund. I don't know if you want to touch on that, Jack.
Sure. So, I seeded the fund. The day it opened, I put in $200,000 of my own money just to get it started. And then of the 2.5 million raised to date, a significant amount of the rest of that is also a very close partner that I've worked with for many years that I do various businesses with. And then I'm actually increasing my investment for a few of the new projects. I'm putting in another $500,000 of my own money into the fund within the next couple of days. Yeah. And that's something that we can, I'm happy to verify. We use a third-party fund administrator. So any potential investors, if they want to verify, my co-invest in the fund, we're happy to share that.
Yeah, good. Awesome.
I did want to touch on the fixed return as well. I talked through the equity classes. The thing about the equity classes is you're in for, likely a 4 to 7 year period. We're using 5 years on the slide here. And there's really not liquidity. You're a partner in an LLC. You're along with us for the ride. So, with that said, we're very highly likely to have all the money returned by year 5 and then just be harvesting profits. Some investors just want a little more certainty or a shorter time horizon. So we do have a fixed return share class at 10% that has a 3-year lockup period. And that works pretty well for the development projects that we're doing, as well as 2 of the multifamily deals are more of a 3-year time horizon to buy, renovate, and likely sell. So it actually matches up pretty well to part of our investment strategy to take 3-year money at a fixed return. And then selectively, we have a 12% share class. That's really more of a case-by-case basis for, I sort of use it like a bridge loan. So we often have opportunities where if we upsize our investment, we can get better deal terms. And, we have a few investors on our capital call list that, say if we need to raise an extra $500,000 to $1 million for a short period of time to lock in on a really strong investment opportunity, we'll take that short-term money. Then we'll, as additional equity comes in, we'll roll off or redeem the 12% share class, similar to how you'd use a bridge or a sort of a private money or hard money loan.
Yeah, awesome. Thanks for covering that, Jack. So if you'd like to see more detailed information or info on the fund offering, you can go to jkaminvestments.com/offerings to see the detailed information there, which includes the private placement memorandum and the subscription agreement and the projects that we've invested in, basically like all the details. We will be sending a follow-up email to all the attendees of the webinar with a link to that. So look for that. So again, we want to thank all you guys for joining us today. You can reach out to us directly with any questions, comments, or feedback you may have. And with that, we'll open it up to some Q&A. Doesn't look like we have any questions at the moment. So if you guys do have any questions, now's the time.
It looks like we have a question about where the next project is. So there's actually a few. The Lexington, Kentucky project, which is 314 units, that's going to close in the next 30 days. And we have a commitment to that project already. There's an upcoming deal in Atlanta, Georgia. That's going to be one of the next projects. That's actually the one that is the same partner that we are already in on the other deal in Atlanta, Georgia. And this is next door to a property that we're not involved in, but they actually own, through a separate fund, they own a property next door. Mm-hmm. And this property is actually being purchased for $10,000 a unit cheaper than the property they already own down the street next door that has been performing really well. So they have their finger on the pulse in that market. And that deal was actually oversubscribed within a few days, but because we're a current investor and current partner, we were able to get in on that deal. And we have a senior housing deal that's likely to fund in beginning the middle of April. That's actually just a very small allocation, but it's a group that builds generally 100-bed senior living facilities in the Midwest, and they generate 30+ IRR returns, but there's no cash flow for the first 12 to 18 months as they construct these. So that's just going to be a very small, like a 5% type allocation. But this group is a really strong track record, and senior living is in very high demand. And post-COVID, actually, newer construction senior living is even in more of a high demand because the more advanced air conditioning systems and the safety features are very, very valuable.
Yeah. Jack, it looks like we got another question here that, are we strict on the minimum investment, and are returns promised annually or quarterly?
Sure. So, for a first-time relationship, we're open to discussing the minimum investment. We do have some hard costs for filing. We had an investor from Massachusetts that came in, and we have to pay $750 to Massachusetts to register the offering. So every time we have someone from a new state, there are some hard costs. But we are really looking to build this brand and build relationships long term.
Yeah. Sorry to interrupt you there, Jack. But in addition to a minimum, it is open only to accredited investors. So that means you make $200,000 as an individual for the last 2 years, or I believe it's $250,000 as a household over the last 2 years, or have a net worth of $1 million or more. It is limited to that, and we use a third party to verify your accreditation. So there's that other criteria there. Sorry, and then go ahead on the returns there.
Sure.
Jack.
Yeah. Thanks for that clarification. And then just real quick on the accredited investor thing too. Retirement accounts do count. So if you have a 401k, IRA, that counts to the net worth. The only thing that's excluded is primary residence. And on the distributions, we distribute quarterly. It is a preferred return; it's not debt. So, in the example of projects that have a very heavy value add or significant construction, it's not a straight line 1.5% per quarter, for example, or at least it's not guaranteed to be. However, we do plan to distribute quarterly, and we're likely to stay on track on an annual basis with the 6 or the 8% or 10% return. So we do budget for that, and we have a good mix of projects that have consistent cash flow. We're actually already getting distributions for the projects that we invested in at the end of last year. So. The plan is to pay consistent quarterly distributions, and with that said, the investors all get paid first before we do.
So sorry, just to clarify that. So just on a quarterly basis, it's not accumulating linearly. It's maybe 1% the first quarter, 3% the second quarter, but on an annual basis, it will be the full percent of your preferred rate. So does that make sense, Jack?
Yes, I think that
awesome.
Better than
Cool. So it doesn't look like we have any additional questions at the moment. So we'll go ahead and jump off here. If you have questions after the call here, after the webinar, don't hesitate to reach out, shoot us an email or give us a call. And thanks again for joining us. Have an excellent day, and we'll see you all on the next webinar. See you guys.